All right, let's dive right into this explainer. We're going to look past all the brand hype and figure out if India's undisputed beer king is actually worth its massive premium valuation. Welcome to Stressfree Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Here's the roadmap for today. We'll be hitting 5 sections. 1, the undisputed beer king. 2, financials under the hood. 3, red flags and risks. 4, valuations, priced for perfection. And finally, 5, final verdict and strategy. Let's get going. Section 1, the undisputed beer king. To set the stage, India's per capita beer consumption is just 3 liters, compared to a global average of 36 liters. So there's a massive growth runway here. And UBL's moat in the structurally underpenetrated market, it's absolutely undeniable. They command roughly 50% of the entire Indian beer market by volume, literally half the market. They are towering over the competition as the defining player in this space. That incredible market share is backed by the global giant Heineken, which holds a massive 70.84% stake. This gives UBL an iconic portfolio, everything from Kingfisher to Amstel. And what's really exciting on the surface, their premium segment is surging. We're talking premium volumes up 21% year over year in FY26. It's a very, very compelling qualitative growth story. Section 2, financials under the hood. Now, let's transition from the brand hype to the sobering quantitative reality, because, well, numbers just don't lie. The crucial thing to look at here is this frankly shocking spike in debt. Just look at how it jumps from near zero, just 10 crores back in FY22, all the way to 620 crores in FY25. Now, this debt was taken on to fund their massive 750 crore Una Greenfield Brewery project, but it also points to a noticeable deterioration in their everyday working capital. Add to that some really tight financial squeezes. We're looking at 3 straight years of negative free cash flow from FY23 to FY25. Plus, their cash flow from operations margin, that collapsed to a mere 2.6% in FY25. And most importantly, their operating margins have been squeezed heavily. They fell from a peak of 18% in FY19 all the way down to just 9%. Why? It's basically a combo of rigid state excise taxes that prevent price hikes mixed with severe input cost inflation. Now, if we break down the math, a rising return on equity from 7.7% to 10.1% looks fantastic at first glance. But this DuPont breakdown proves that recent ROE improvements are heavily leverage-driven from that new debt we just talked about. It's not genuine margin expansion. You can clearly see the equity multiplier rising while the asset turnover is actually declining. So the quality of that return, kind of questionable. Section 3, red flags and risks. With the financial engine sputtering a bit, there are specific details you absolutely need to monitor. First up is this huge number, 751.83 crore rupees. This represents a massive regulatory hangover. It's a penalty from the Competition Commission of India for alleged cartelization. It's currently pending a Supreme Court appeal, and if UBL is forced to pay, that's a staggering 170% of their annual profit. Definitely something that could derail things. And step by step, we're seeing ballooning debtor days. Just look at this progression, from 68 days in FY23 to 104, and now up to 117 days in FY25. This essentially means it's taking them significantly longer to collect cash from state beverage corporations. It's tying up their vital working capital, and that's never a good sign. But perhaps the starkest contrast of all is right here. Their return on incremental invested capital over the last 3 years is just 6.2%. That sits way below their 12% cost of capital. In plain English, they are essentially destroying value on new investments right now. Section 4, valuations, priced for perfection. This brings us to the climax of our explainer. How is the market pricing all this data? Are we getting a discount for all these risks, or are we paying a massive premium for the brand? We really have to ask, with rising debt, negative cash flow, value destruction on new capital, and heavy regulatory risks hanging over them, does a rich valuation of around 107 times earnings make any sense at all? It really comes down to a battle of narratives. On one hand, you're buying into the bull case, paying up for that massive premiumization potential, and hoping operating margins quickly recover to around 14%. Or, on the other hand, you're deeply exposed to the bear case, severe execution misses, regulatory roulette, and stagnant margins. It's quite the tug of war. Section 5. Final Verdict and Strategy. Time to synthesize all these findings into a clear, stress-free takeaway for your money. How should we actually approach this undisputed, yet currently challenged king? Well, based on their incredibly strong qualitative moat, but poor near-term earnings quality, UBL scores a 61 out of 100 on our model. That lands it firmly in the hold or watch list category. It's an amazing franchise, no doubt, but it's going through a very tough financial cycle right now. To get a proper margin of safety given the risks we just outlined, the data heavily suggests waiting. We recommend looking to accumulate only if the price dips below 1,500 rupees or if the company's operating margins prove they can actually sustain a recovery above 11%. Right now, patience is absolutely your best asset. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free.